In April 2026, 26% of all corporate layoffs in the United States were directly attributed to artificial intelligence, not automation broadly, not offshoring, AI specifically, documented in company filings. That number was 5% in 2023. It tripled in under 3 years. The question most people are asking is the wrong one. They are asking which jobs AI will replace. The more useful question is, which income streams cannot be replaced? And the answer has nothing to do with jobs. AI replaces labor. It does not replace ownership. It does not replace physical presence. It does not replace legal accountability. That distinction is the entire framework. The International Monetary Fund estimates 60% of jobs in high-income countries have meaningful AI exposure. The World Economic Forum projects 92 million displaced roles by 2030. PwC's June 2026 Global AI Jobs Barometer found that jobs requiring human judgment and accountability are growing twice as fast as other roles, with 42% higher wage growth attached. The labor market is not being flattened, it is being split. The people on the wrong side of that split are the ones still depending entirely on a salary. The first AI-resistant income stream is physical assets. AI cannot own land. It cannot own a building. It does not create housing demand, does not retire from the construction workforce, and does not change the fact that 45 million American households are renters paying monthly. The average equity REIT dividend yield in 2026 runs between 3 and 8%. Mortgage REITs yield 9 to 12% or higher, and the yield that high is always a risk premium, not a free lunch. It reflects leverage, interest rate sensitivity, or credit exposure. These returns come from rent collected on warehouses, apartment buildings, medical offices, and senior housing. Physical structures that produce income whether the labor market is healthy or collapsing. Realty Income owns over 15,000 properties and has paid monthly dividends without interruption for decades. The yield sits near 5.09% in 2026. The company does not care whether its tenants automate their back-office staff. It cares whether they pay rent. They do. Here is the mechanism that most people miss. When a company automates 30% of its workforce, profit margins expand. The shareholders capture that expansion. The displaced workers do not. Owning the asset puts you on the side of the equation that benefits from automation, not the side that absorbs it. The housing affordability crisis is creating structural tailwind for rental income. Buyers are being priced out of ownership. The median home price reached $417,000 in early 2026. Monthly mortgage payments on a median-priced home have nearly doubled since 2019. More Americans will rent for longer. That rent flows to asset owners. The honest caveat: direct rental property is not passive. Managing tenants, maintenance, and vacancies requires active involvement. REIT removes operational burden, but introduces stock market volatility and interest rate sensitivity. Both structures work. Neither requires competing with a language model. The second AI-resistant income stream is physical skilled labor, where robotic deployment is economically irrational. Skilled trades wages in the United States rose 30% in 4 years. The primary driver is the AI build-out itself. Every data center that Meta, Google, and Amazon are constructing requires electricians, HVAC technicians, and structural workers. Software cannot wire a building. Meta announced in June 2026 a $115 million investment in 5-week skilled trades training programs with guaranteed employment. This is not philanthropy. Meta cannot build its AI infrastructure without people who can run conduit through a concrete wall. The demand created by AI is directly increasing wages for the workers AI cannot replace. The National Association of Home Builders estimates the construction industry needs 2.2 million new workers over the next 3 years. 41% of the current skilled trades workforce will retire before 2031. There are currently over 530,000 open positions. Electricians, plumbers, and HVAC specialists earn between $62,000 and $120,000 or more depending on specialization. The reason AI cannot profitably replace this work is variable environments. This applies specifically to renovation, repair, and custom installation. Work done inside existing structures, where no two jobs present the same physical constraints, cannot be standardized into a repeatable process. Modular and prefabricated construction is moving toward factory automation, but that segment represents a fraction of total field demand. The retrofit market, aging housing stock, and custom builds cannot be automated at scale. Robotic deployment requires repeatability that fieldwork does not provide. That calculus does not change in the next decade. The psychological reason this category is undervalued. 2 decades of cultural messaging directed everyone toward 4-year degrees. The pipeline of skilled workers collapsed. The shortage is now structural, not cyclical. The shortage is the income opportunity. The honest limitation: trades income is active and requires physical presence. It does not scale without building a business. It is high cash flow labor, not a compounding asset. Its value is in redirecting the income into something that does compound. The third AI-resistant income stream is capital, owning a share of the companies deploying the automation. The S&P 500 rose approximately 88% between January 2021 and January 2026. That return did not come from workers earning more. It came from productivity gains captured at the ownership level. The companies deploying AI reduced their cost of production. The shareholders took the margin. A total market index fund captures the return of the entire U.S. equity market at 0.03 to 0.04% annual cost. No prediction required about which AI company wins. No stock picking. The fund owns the infrastructure companies, the semiconductor manufacturers, the utilities supplying power to the data centers, all of it, weighted by market value. The math on participation versus delay is specific. $15,000 per year invested at the historical S&P 500 average of 10% annually, starting at age 28, produces approximately $5 million by age 65. The same contribution starting at age 38 produces approximately $1,800,000. The cost of 1 decade is $3,200,000 in terminal wealth. That is compound interest applied to a consistent contribution. The sectors with the strongest structural tailwind: data center infrastructure, power utilities, semiconductor manufacturers, and healthcare technology. These are not speculative bets. They are the physical infrastructure the AI economy requires to operate. The sectors to exit as long-term income positions: generic content production, customer service operations, and administrative data processing. These are not exposure positions. They are displacement targets. Holding them as income sources is holding a short position against yourself. The fourth, AI-resistant income stream is the human accountability premium. PwC's 2026 data found that new tasks added to AI-exposed roles are 2.5 times more likely to require empathy, judgment, and personal accountability than tasks being automated. Workers with advanced AI direction skills earn 56% more than peers in the same roles without those skills. The market is paying for the human layer that AI output requires to be acted upon. The highest protected income positions share one structural characteristic. The cost of being wrong falls on a specific human being who can be held legally accountable for the outcome. A physician making a diagnostic decision bears that accountability. An attorney structuring a transaction carries liability. A fiduciary financial advisor can be sued. An AI system cannot be sued. That is not a technicality. It is a fundamental limitation on where AI can legally operate as the decision maker. AI will handle the routine diagnostic work, the standard contract clauses, the template financial analysis. The income premium will concentrate in the professionals who interpret that AI output, apply contextual judgment, and put their name on the conclusion. The industry term for this structure is human in the loop. It is now the regulatory and legal standard in finance, healthcare, and law. Not because institutions prefer it, but because liability requires a human signature at the decision point. That layer cannot be automated because the accountability requirement is structural, not technical. The framework that connects all 4 categories is simple. AI replaces execution. It does not replace ownership of physical assets. It does not replace physical work in variable environments. It does not redistribute capital. It cannot occupy a legal accountability position. The combination that works for most people with limited starting capital. Skilled trades income directed into index fund investment over time. Trades pay $70,000 to $120,000 immediately, with no 4-year degree required. That cash flow, invested consistently over 15 years, builds the asset base that changes the equation. The labor income provides the funding mechanism. The capital income provides the compounding. The mistake is waiting for the displacement to happen before restructuring. By the time a role is automated, the window to redirect that income into assets has already closed. The April 2026 figure is 26% of layoffs attributed to AI. 3 years ago, it was 5%. The acceleration is not linear. The time to build income structures that do not depend entirely on labor market position is before the labor market position disappears. That is not a prediction about a distant future. It is a description of the current quarter. The structure either gets built now, or it gets built after a disruption forces the issue. The second path costs significantly more.